Hello everyone, this is Brad Tennant coming to you from B.E.S.T Wealth Management. I wanted to take some time today and discuss the recent market volatility that the stock market has recently experienced. We've certainly been on a bit of a roller coaster ride, and there has been a tremendous amount of volatility. And an interesting thing about the volatility is that this is not something that we're used to, at least recently. If you go back to, say, 2008, recession during the mortgage crisis, for the last 10 years since that point, we really haven't experienced a lot of volatility, especially on the downside. The market has mostly gone up, so the volatility has been on the upside, but there hasn't been a lot of volatility on the downside for the last 10 years. But recently, we've seen from January of this year through September, we've seen the market increase at about 10%. And then October and December happened. In October, the market was down roughly 7%. November was up around 1 or 2%, but December dropped around 16%. And this is the volatility that we've experienced over these past couple of months. And it's volatility on the downside. And as I said, we haven't really experienced this over the past 10 years to this degree. And so what's really happening is that the market is just returning to more of a state of normalcy. The stock market in general is very volatile, and we're now just starting to see that come back to light again. And so I know that this volatility that's going on right now, especially with these large declines, has created some concern for you and for a lot of people. People are concerned whether or not they should be making a change to their portfolio. They're concerned if they're in retirement and they're wondering what they should do. They're afraid that they're going to run out of money because they're now taking money out of a portfolio that's down in value. And so I wanted to take some time here to address the volatility. And in fact, I'm going to be doing what I think is going to be a 5-day series on market volatility, and what's been going on and what you should do. And so this first video that I'm going to be doing today is going to be about tuning out the noise. And I think that people are certainly fearful, but one of the things that I hope to do during today, as well as throughout the entire 5-day market volatility series, is to help you to understand why I'm not concerned, and also why you shouldn't be concerned either. So let's start with today's topic, tuning out the noise. You've certainly seen the headlines that have been floating around, cable news, magazines, newspapers, so forth. Some of the headlines that I've seen said things like, "This is the worst December on record since 1931. That's a pretty powerful statement. There's been other headlines such as Christmas Eve was the worst trading day ever. Or one of my favorites is the September, where we have entered, the S&P 500 has entered bear market territory. And by definition, a bear market is historically defined as a 20% decline or more. But why really shouldn't you be concerned? Let me explain. So if you go back from January of this year through all of September, the market was actually up 10%. And then you see those headlines from September to today, where the S&P 500 or the U.S. stock market has entered bear market territory or declined 20%. And so if you look at September, or really October through today, which today is December the 28th, the market has declined roughly 20%. I think it might have crawled out of the bear market territory slightly, but for the most part, it's been down about 20% from the highs. But we can't forget that we had a 10% gain all the way through September. And so when you boil it all the way down, even though October was a bad month at 7% down and December was a bad month at 16% down, year to date, the market is only down about 8%. And if you listen to the media, you would think that we're going through some period of Armageddon here that we haven't experienced before. But 8% is certainly nothing near an Armageddon-like situation. But the media is famous for selling fear, and they're they're in the entertainment business, not the financial advice business. And then furthermore, if you go back to the election, which is a pretty common metric that people use to measure stock market performance, if you go back to November of 2016 through today, the markets are still up 16% cumulatively. So we can't forget about the gains that we've experienced so far. And if you think about it even further, people were okay with the volatility on the upside since the election, but now people are not concerned, are not okay with the downside volatility that we've recently been experiencing over the past couple of months. So my message to you is to tune out the noise, understand that volatility is normal. We just haven't experienced it much over the past 10 years, and we've somewhat gotten complacent. So tune out the noise, maintain a long-term approach to your investing. And by the way, if you aren't maintaining a long-term approach, or you need to access your money in a short period of time, then perhaps that's an ideal time for you to evaluate the amount of exposure that you have to the stock market, because likely you don't need to have that amount of exposure in the first place. So if you have any questions regarding that or any comments in general, I encourage you to leave them directly below this video. And if you're not signed up to receive our e-content, then I encourage you also to sign up directly below this video to sign up for the upcoming market volatility series that I'll be doing. So thanks for tuning in. Look forward to hearing from you. Take care.